After the conclusion of the Fed's two-day meeting, it failed to give market and rate watchers a clue as to what to expect next. That's because it removed any language that might indicate a date for the first interest rate hike. Regardless of when rates rise, the Fed has turned the first rate hike into a guessing game. This speculation and uncertainty will offer many opportunities to profit, but some investments may suffer from an initial market overreaction. The market overreaction is going to be simple. Stocks will sell off, bonds will sell off, reflecting higher Treasury yields, and the dollar will rally. These swings will be only temporary. The Fed is trapped and can't significantly raise rates because of our high debt levels and fragile economic recovery. But these swings will still likely happen, and when they do, they will be quick. There's one investment class that will feel the bulk of the pain: high-yield corporate bond exchange-traded funds, otherwise known as junk bond funds. Since the Fed introduced its zero interest rate policy, investors have poured money into non-traditional areas. While stocks offer capital gains, as well as a highly liquid market and increasing dividends, corporate bonds don't carry the same benefits. Yet, they have been gobbled up as if they were risk-free income because of opportunities to collect any sort of stable income. The big concern is that investors are adding exposure to this junk-grade debt through ETFs. At first glance, this investment vehicle offers many attractions to individual investors. It's a highly liquid way to benefit from higher corporate bond yields versus treasuries. But looks may be deceiving. The liquidity is present because so many investors are buying these bonds and ETFs. If the buying slows, or better yet, reverses as investors overreact to the Fed raising rates, it will cause these ETFs to sell their bond holdings regardless of price, which will result in drastically lower prices, negatively impacting overall returns even if you plan to hold the ETF for years to come. Already in 2015, inflows into corporate debt are up more than 300% compared to last year, and ETFs have accounted for 45% of those inflows compared to just 7% a year ago. That's a cause for concern, especially considering new regulations imposed after the 2008 financial crisis. Banks in the U.S. are no longer encouraged to hold riskier debt, such as high-yield bonds. Historically, banks have been able to step in during sell-offs to improve liquidity. They won't be there next time. When the Fed decides to raise rates, even if it is gradual, it will likely cause an overreaction in those high-yield corporate debt holdings. A normalized interest rate policy will cause U.S. Treasuries to generate greater income. As a result, investors will flood out of high-yield corporate debt in favor of less risky investments. For now, make sure you don't have any exposure to these high-yield corporate ETFs either in your 401k or personal investment account. Until next time, stay sovereign.